James, Lavish, Preston Pysh. Thanks for being here. How you doing?
Thanks for having us. Doing great.
Great to be here. This awesome studio.
It's
Love
my
it, yeah.
absolute honor to have you guys here. I was just saying, I've watched you, before I started my account.
Yeah.
I was just a lurker like anybody else. And so now here I am sitting across from you, hosting you in my studio. So that's quite surreal. It's
Well, you've been crushing it for years, man. You've been putting out some like very high signal information for folks. And I'm a avid fan and follower of what you're doing.
I really appreciate that. Yeah, I started this account just as a way of, just getting involved in the community because I put all of my money into Bitcoin and I'm like, now what? I'm watching the news daily, and then it was just a way to get involved, and suddenly it's just become an opportunity to build out something a little bit more. And here we are doxing ourselves 4 years later. I wasn't sure this moment was going to come either, but here we are. Yeah, James, how you doing?
Awesome. You're the go-to source for the news. Awesome.
Oh, thank you. Really, Did you hear that, everybody?
Small plug.
Markets have been quiet. So just to let everybody know,
This is boring.
Yeah, Trump is in office. We'll probably release this as soon as we can edit it, but after the launch. And Trump is in office, well and truly in office, and he's gone crazy with his tariffs. Some people seem to think that there is a bit of wisdom behind his madness. I'm not so sure. And I'd love to start this discussion off not really going into guessing what his motivations are, but just what has happened so far and what has been the downstream effects of that. Because I think once we get into gleaning guessing what his motivations are, it can quickly become a political topic that I don't really want to get into. So, what has he done, and what's been the reaction so far? Over to you guys.
Right at the beginning of the year when Trump was inaugurated, we started hearing about tariffs. We were worried about them late last year. The market started talking about them and anticipating them. And so you could see the markets start to get a little bit jittery and worried about some of the stuff he was talking about. Not to get into his motivations, but basically what he has done is, and the markets have, sequentially reacted to tweets or, releases from Besant or, but the uncertainty that's been around this has been incredible. And it's because the market just keeps reacting to all of these, the whatever the policy is today. But then they thought that they were anticipating what he was going to do, and that we know that Trump has done this before. He wields a big sword, and he wants to use the tariffs as a threat because he wants to win something. He wants to win something out of this whole fight, right? And he wants to somehow tip the balance of trade back to the United States and re-engage our manufacturing industry. And so that he's made clear, and because he keeps saying he's for Main Street, not for Wall Street. Okay, so then last week he comes out and says, okay, he's got this big chart, marches out into the White House lawn with this big chart, and the chart says, here are the trade imbalances and of all the countries, and here are the tariffs that we're going to now levy on these countries. And it was like 10% minimum on everybody, and poof, the market reacted violently. And so that's kind of still where we're at. And he said these are going to be enacted in 10 days. Like literally start the countdown. If you don't come to the table, this is what's happening. The word is he's gotten a lot of countries, up to 70 countries, that have reacted and said, we want to negotiate. And the market has been doing this gyration over the last number of days, saying, well, is he going to negotiate? Or is he just going to keep have this iron fist, or keep this big sword as a threat to get even more out of them? And so you're seeing the market react to reports that, oh, he's going to delay the tariffs, which I thought all along he would do, but he hasn't yet. And so they're like, well, is he going to delay them and negotiate or not? And I think, again, not to get into his motivations, but it's kind of obvious. The big prize is China. And that's been the talk. And now the war that he is waging on all these countries really has to do with China, in my mind. And China has come back violently themselves in a number of ways. And we can get into that a little bit more. But that's kind of my read of where we've come from and where we are now.
The only thing I would really add is I think the market at large was just kind of expecting him to haggle with maybe China or maybe another country like Canada and Mexico. Like we were seeing this back and forth very early on. The market was somewhat reacting to that, but there wasn't like an enormous sell-off or major concern that he was going to just one morning wake up and roll out this giant chart and say, all right, this was the trade deficit that we have with everybody, and places like China and others, it's very substantial. And across the board, like these are the new taxes that are going into effect effectively immediately, and go. And I think the whole market was like, hold on a second, what? Like say that again. And so that's why you're seeing just violent market reaction right now. Now, does some of this get turned off in 2 days from now? Because it's like, oh, well, we talked with China, we talked with this other country, this is what it is, and we're dialing back all these other, who knows? Like, I think this is a really dynamic situation. And I think that the pace of the sell-off that's happening, especially in equity markets and fixed income markets, I mean, it's a stronger pace from like an RSI standpoint. It's stronger of a sell-off than it was in COVID, believe it or not, based on what we're seeing in RSI metrics.
In equities and bonds. And we talk about that. But why are equities reacting like this?
Before we get further down onto that, I know there's been a lot of confusion about exactly what a tariff is and who pays that, mainly due to the misunderstanding by the president himself that he's propagated by saying it's kind of like, we're going to build a wall and Mexico's going to pay for it. We're going to slap tariffs and China's going to pay for it. That's not actually what happens. A tariff is a tax imposed by the receiving country on the goods being imported by an exporting country. So Chinese goods coming to the United States will be tariffed or levied a tariff on those. And China does not pay for that. It's the American consumer who will pay for that. And the effect of that, essentially, is to make domestic production more competitive. This is in theory, but we know that industries cannot be switched on just like that. It takes years and years, and there has to be some certainty and confidence in the new policy change for the investment industry to support entrepreneurs in scaling or building out and scaling up these new endeavors as well. So there's no certainty that that's going to happen. So even if that's why I was like, okay, if they want to reindustrialize, there's no certainty that's going to happen.
And
so it's not like
a very long time.
Yeah. And so,
look, Archie, if you think that we're going to bring the industry back, we're going to bring manufacturing back here, right? And we keep talking about this. Lutnick and Besant and Trump are talking about this, bringing we're going to rebuild American manufacturing. Just the timeline that takes for the companies to source land for a manufacturing facility, for them to get the approvals, all of the necessary approvals to build that facility the way they want to build it, to
the aptitude of the worker.
Exactly. You've got to teach the workers, or you've got to spend a lot of money on robotics, whatever it has to be. But that's going to be that takes years. This is not a midterm kind of event, right? This is going to take years and years. But I want to go back to one of the things you were saying, and the idea is to bring the manufacturing back here by levying the tax on those goods from the foreign suppliers, foreign manufacturers. But it's kind of twofold, right? Because you're going to put the taxes on those goods, and what he keeps talking about is lowering taxes for the United States citizens, for the Americans, right? He wants to lower the tax. He wants to get rid of the IRS. They keep talking about that too. Like, okay, great. I mean, we as Bitcoiners, yes, let's get rid of the IRS. But how do you replace that? Well, you have the external revenue service, and these are the tariffs. But what is that? A tariff, if the manufacturing doesn't come back here immediately, then goods that the consumers that spend the most of the money are boomers and the top 10 or 20% of the demographic, right? Well, they're going to now pay $2,500 for this $1,000 phone or $3,000. So what is it? It's a consumption tax. And if you ask all the people in America, especially that lower demographic, would you be okay with lowering taxes for everybody and then just raising consumption tax? They would say, absolutely, because a billionaire can go buy, another yacht and pay that big consumption tax. I'm good with that. Are you good with that? Sounds good to me. So I think that's the mentality. Now the math on that,
just even the logical argument doesn't make sense really, because what you're essentially doing is you're providing cover for inefficiency and inferiority as well. And so it doesn't. You're going to pay a lot more for a lot less in terms of quality manufacturing. So
right, and as Bitcoiners, you're like, this is the exact opposite of like, this should be going down in price. It should not be going up in price because the technology is advancing, right? And it's cheaper to make this today than it was in real terms. When you get into the fiat problems, that's a whole nother issue. But like I agree.
So the argument, and I see a pump on the timeline going hard on pro-tariff bull posting, but the argument that America is going to reindustrialize presumes that there's some kind of 1970s style industrial bonanza just waiting to be taken. But what we're now seeing, and one of my concerns that I spoke to someone in the AI sector, industrialization introduced mechanization to a lot of very manual tasks that allowed people to do higher value work. Mm-hmm. But now we've got the combination of AI and robotics. AI does the higher value intellectual work, at least at the moment, that the kind of work that can be structured the kind of work that uses structured knowledge, it does that really, really well. But they're only going to get better. The AI is the worst it's ever going to be right now, and it's only getting better, and it's getting better faster as well. And then we have robotics that are getting better as well. And so a combination of AI and robotics is going to mean that there's actually nowhere up the curve for people to move. So a lot of the analyst positions. So when I graduated, I got onto a bank's graduate program. I tell you, 99% of the work that we did was Excel and PowerPoint.
Yeah.
And none of that needs a graduate to be doing it. None of it needs a junior analyst or even a midweight analyst. You need a senior analyst to do some of the thinking, and then the AI can power most of the production and the grunt work behind that. So you can see now a lot of sectors of the economy are going to collapse when it comes to employment demand. And not just blue collar, but white collar as well. And I think historically there have been sectors of the economy that have taken refuge and kind of gleefully looked upon other areas that have been getting smashed. And we know that Silicon Valley versus media, for example, learn to code was a famous quip that a lot of people from Silicon Valley told journalists. But that's sort of coming back to bite us now. I know with some of the things I've been experimenting with, AI guided and directed code generation, app building. I used it for 2 hours the other day, and I was astounded.
It's insane.
Astounded at how close to the mark it got.
Yeah. And
I was just sort of casually prompting it to build what I wanted. I'm going to set aside a couple of days to actually build this app that I need for my business. And I'm 99% confident I'm going to get pretty much everything I want, as well as I possibly could have if I outsourced or hired a dev. So it comes back to, where are people going to move on that curve, on that productivity curve with respect to employment. There's nowhere for that to happen.
Yeah.
So the reindustrialization is what? Bringing back robotics and AI to do the work that would otherwise be done externally. Do you need tariffs for that?
That's the part that it seems like they're acting like that's not going to be the case and that there's going to be humans doing this. And I mean,
and it's not.
I don't see that happening. Yeah. And I don't see it happening anytime soon. One of the things that I think is important for like the listener to really understand is what incentive created this situation where you have a massive trade differential between what the US and the rest of the world has. Like, how did we get here? Like, what caused it? And because Trump has been going around since what, the 80s, talking about this trade deficit and how there needs to be tariffs, and like all these other countries are quote unquote screwing the US by them putting tariffs on anything that we export and us not doing the same when it comes back inbound to the United States. But what I think is just really misunderstood is the reason that whole dynamic has existed under the petrodollar system is because the dollar has been, that inflation has been printed and sent out the door, and the dollar arbitrage that the rest of the world has conducted against the dollar versus their local currency is why this whole dynamic exists. And so to think that doing that for 40, 50 years, and now all of a sudden, because nobody wants to save in treasuries anymore because of the math, doesn't work anymore. And that's because yields went from 16% on the 10-year down to nothing, or 50 basis points over that 40-year period of time. And the rest of the world can do the math. And they were looking at it and they were saying, well, this don't work anymore. And you have Trump that's finally able, he's been talking about it for years. He's like, well, now I'm going to do this, and I'm going to put all these tariffs on and reverse this 4-decade trend. And like, you're not going to do that in 1.5 years before his midterm elections, where if he doesn't have the control in the House and the Senate, he can't do anything, right? So like, and James and I had a conversation about this, offline, and we're just looking at it and we're saying, we understand like the story he's telling himself. I just don't think he has an appreciation for what was the asset through all that. The asset was you could just print a bunch of dollars, like push them out the door, and like you're not really producing anything other than financializing the dollar globally, and in exchange you're getting physical things in exchange for that. So like that asset, that playbook worked really well for the US. It worked really well for the rest of the world because they could store their savings in treasuries that went up in value because the yields kept getting compressed. So everybody liked this until the math didn't work.
I just want to interrupt you there about everybody like this, because there's kind of a tacit agreement globally that the United States would have the global reserve currency.
Yeah.
Could you break down that deal? What did the rest of the world get for that, and what did America get for that?
Yeah.
And so, it's easy to have a look at that situation as Trump has, pick one component out of it like he has with trade deficits and says we're getting ripped off. Yeah. But actually it was a hugely beneficial situation for the United States. So can we just lay that out as a sort of framework for understanding the world post World War II, how we got there? Yeah. And then why it's not the most accurate representation to say trade deficit, therefore ripped off.
Yeah. Luke Roman has a quote that he says the number one export that the U.S. has had over all these decades has been the U.S. dollar. And I think it really represents, and when you take a step back and you look at it, it's kind of like, it's really weird to think about our ability to just create this paper and exchange it for physical goods and services all over the world. And Alex Gladstein talks a lot about the IMF and the World Bank and how so that also ties into this whole thesis, which, we could go down that path, but just, I'm going to kind of wave my hands and tell you that's all interconnected, is we were able to consume by just creating all these paper receipts and promises that we wouldn't debase these units, these monetary units, in exchange for all of this physical stuff that we were consuming. And it works as long as those paper receipts continue to appreciate in value, while the person who received them in exchange for their physical work and goods can go out and exchange those paper receipts for something else that they want. But once that math breaks down, and for me, I think the key point, like the snapping of the chalk line where all of that change was actually COVID. That's when you saw the 10-year Treasury hit, 50 basis points, which means, in bond prices, it was peaked out. So like if you were saving all your money in bonds through all those years, like you were at sky high prices. Yep. And ever since that moment in COVID, the bond market has just struggled. And now look at it. Like they're trying to get yields down. They can't do it. It's because the math is not there anymore. And so go ahead, right. James. I've been talking a lot.
No, and that's a really good point. So you're seeing the 10-year Treasury. Okay, for the listeners, the 10-year Treasury is that is the benchmark bond.
A Treasury bill is what, James? Just really quickly. We don't want to go too deep.
The U.S. Treasury bill is a bill issued, a bond issued by the United States. Okay, they call it a bill because it's only up to 10 years. The bonds are,
So when the United States government wants to borrow money, they sell a bond.
They sell a bond, right? And so, this is right. We laugh about this, but one of the White House economic advisors didn't understand this how this actually works. But so the United States, and this goes to the Triffin dilemma, right? And we can talk about that in a second. But the United States, they sell a bond. Another country gives them they give them money, so they borrow the money, right? And then they pay that back on the interest rate of that bond. Okay, so the 10-year Treasury is the benchmark bond of the whole world, not just Treasuries, but the whole world. Like everything is looked at from the 10-year Treasury. And what's so crazy about this is that the 10-year Treasury has gyrated violently since the time that the Fed started lowering rates. Okay. At the same time, the Fed started lowering rates back in the fall because inflation was coming down, and they feel like they're tackling it, and they were a little bit worried about employment. So they start lowering rates. At the same time, the 10-year Treasury, they lowered rates by 1%. The 10-year Treasury, the yield went up by 1%. Why is that? Well, it's because people are worried about inflation. They're worried about this deluge of bonds, or just a tsunami of bonds are going to come onto the market because of all of the deficits we're running. Like we're running multi-trillion-dollar deficits. So then you've got the Doge Commission that comes in. They start cutting, costs. They say they find some fraud and they start cutting some things, but they've cut about $250 billion per year so far. The issue is that we're running multi-trillion-dollar deficits. You can't get there by just cutting the fat. Like you have to cut out every single discretionary program.
And not to mention all of this math that he's talking about, combined with the tech deflationary effects that you were talking about with robotics and AI, combined with the tariffs that everybody's looking at these numbers, and like what you had said, Archie, is what's this going to do to the prices of everything in the country when you literally just imposed a consumption tax effectively on everything? Well, it's going to bid all the prices. And so anybody who's sitting on bonds, they're looking at the math of that plus the other two things, and they're saying, this
doesn't add up.
Like, if I'm buying this long term, I'm going to get totally screwed. Now, in 30 days, whatever the speculators think, I have no idea. But long term, you can't sit on that. You're going to get absolutely wrecked.
So when you mentioned the Fed rates going down and market rates going up, they're two separate signals essentially saying the same thing, even though they're moving in the opposite directions.
The shortest term paper is the Fed funds. That's the overnight rate that everything's supposed to be keyed off of, and the whole yield curve is keyed off of that. And you're right. Yeah,
and it has to stay positively sloped, or else banks get wrecked, and that's an important piece. You can't have the federal funds rate at call it 8% in the long end of the curve at 5%, because the way that banks' balance sheets work is they structure the entire balance sheet off of a positively sloped yield curve, right? So that's important.
So, but now what we're seeing, and this is the key to everything. So now what we're seeing is that suddenly these tariffs are it's not even just a threat, like it's happening. And so now the 10-year Treasury has gone from it went all the way, the the yield went all the way up. It came all the way back down because it looked like, well, we're going to tackle these deficits. We're going to lower the deficits. It looks like inflation's coming in, and actually it looks like the economy's rolling over. So rates are going to have to come down. So now the 10-year Treasury yield comes down, okay? And for all the listeners, when the yield of a bond comes down, the price of the bond goes up, right? Because it means that you're paying more for that bond, and that drives the yield down.
There's more demand for the bond, more risk capital, or the more demand for the, there's more demand for that bond, so the yield goes down.
They're willing to take less of a yield out to the future, and that means that they're willing to take more risk on that interest rate risk of the interest rate going up in their face, or duration risk is what, and so, or just the outright bond risk of the U.S. Treasury. Like 10 years from now, where's the Treasury going to be? Is it going to be the benchmark bond of the world? We don't know. And now what you're seeing is suddenly it came all the way back down. And then these tariffs happened last week, and boom, they skyrocketed back up. And you've seen the 10-year Treasury now trading all the way up to 4.3%. I haven't even looked at the market yet this morning. God only knows, but I posted about it. It's like, this is a problem. So what's happening? What is happening? Well, there's multiple things could be happening. Number one, people expect China now to retaliate by selling U.S. Treasuries. Why would they do that? Well, they would do that because they've got to defend their yuan, their currency. How do they do that? They sell U.S. Treasury, get U.S. dollars, sell U.S. dollars, buy yuan. Does that make sense? Sell U.S. Treasury, get U.S. dollars, sell U.S. dollars, buy the yuan, and that supports their currency. So,
but the retaliation is even bigger than that. I saw something yesterday that China was going to stop exports on 7 of their different precious metals out of the country. So why is that important? Well, what's the number one industry in the United States from a competitive standpoint? Like, if you were going to almost look at the United States as a business and say, what's our competitive advantage? It's actually the aerospace industry, making Boeing, Lockheed, like making
defense,
very complex end items defense, which is, smirk-worthy. But that's the competitive moat of the U.S. If you don't have these types of input materials, can you go out and make these types of complex end items that are reliant on precious metals and very hard, strong, light materials? No, you can't. Or you have to go stand up some type of infrastructure locally or source it from somewhere else. And if you think that happens quickly, like, you're sorely mistaken. So
I saw a chart
Yeah.
that mapped out basically the military industrial complex of the United States, and everything is dependent on Chinese
Absolutely.
value chain. So
The inputs, yeah. Yeah. So that's the thing that I think is really naive. Is like, it's not as simple as just saying, oh, we're going to levy this tariff on you, and because we consume so much, we're going to bring you to your knees, and you're going to,
and your economy is kind of on the edge, so we're going to drive it home at the point where you're already at pain,
and they're looking at it and they're saying, no, like, you have to. It's almost like food, right? Like, you could go to somebody and they're giving you food, and you're saying, I'm going to totally screw you with all these paper promises, but like, you're the one that's like farming out the crop. And so, like, when you look at all these inputs to our economy and where they're coming from, all these other countries are looking at the U.S. and are like, are you serious right now? Like, don't you realize where you're getting it, all this physical stuff from that, like, is required for everything that you do inside of your country? Now, like, from a strategy standpoint, one of the things that I think is interesting to think about is if you really wanted to try to, like, implement tariffs and you wanted to reshore work back in the U.S. so that you're not just the country that's printing paper receipts and that's your export, right? And you got to try to incentivize this to start coming back. Do you go out and do you punch everybody in the face at the same time? Or do you go to the biggest person on the block and punch them in the face and try to work a deal, and then go to the next one and try to work a deal so that you can kind of manage the chaos? I don't know what the right approach, I don't even know if it is the right approach, or we're just dealing with a dying system and there's no, like, right answer. But I kind of think the fact that they rolled it all out at once has just created like this
Chaos.
total chaos in the market. And
The market hates uncertainty.
yeah,
And so now what you have is you've got these bond yields that are rising, and I just pulled them up just to
what are they?
the 10-year yield is now up another 3.5% at 4.44%. That's mental. The 30 years at 4.9%. We're going back to 8% mortgage rates here. That's where we're headed. It's going to break the economy. Okay, so now you think, okay, why are they doing this? Well, we keep hearing Scott Bessent saying we need to move out in the Treasury curve, okay, on our bonds. Okay, what am I talking about? We have over we have like $1.2 trillion of interest expense on our treasuries annually. That's a massive amount of that deficit.
So let's mention the elephant in the room, which is the United States government debt. What is it sitting at now?
120%.
36 trillion.
$4 trillion. And that's the limit. It was set on January 2nd or whatever. That's the limit right now, because we don't have a debt limit beyond that. So
there's no authorization to borrow more yet.
There's so many pieces here that it's crazy, Archie. So we don't have a way to move that goalpost anymore. It gets moved every couple of years. We're running that down. So we're using the Treasury General account, which is the cash account. That's like the checking account for the Treasury. The Treasury is using that, and they're implementing extraordinary measures, which means that they're not paying certain intergovernmental agencies. They're like saying, well, I don't have to pay that. I got a 30-day or 60-day or 90-day grace period on that one. I don't have to pay that bill. Okay. I'm not going to pay that until I really have to pay it. So they're doing that internally, which is like, we're talking about payments to pension funds internally, like military pension funds and stuff. Like or post office pension funds. Like this is just crazy, right? So that's the first thing that they're doing. But go back to the $1.2 trillion of interest expense. So we're running that down, and we've got until somewhere between June and August, and that's gone. And then we trip that debt limit because we have to borrow more money to pay the bills. So Congress is going to find themselves up against the wall again. And here we are. We're marching right down that path to make the decision on what's going to be in this budget. And that's where we're going to find ourselves again. Okay. So why is this important? It's important because we have $9 trillion of debt that is maturing this year.
So let's put these trillions into some context, because when we talk about such big numbers, I think perspective can sometimes be lost, right?
Yeah, sure.
So in the context of the American economy, which is how many trillion? Is it 30, 33 trillion?
It's 29 trillion.
29.
It's actually, yeah.
So the debt is significantly larger.
It's massive. Relative to that.
Yeah, relative. So that's quite a large number. Once you get over 100%, it's a bit dicey. Like you've got to put some things into order.
We're at 120%.
Okay. And the interest expense is how big in
It's about $1 trillion right now.
the budget?
$1.2 trillion, but that's not net.
What's the biggest budget line item?
Defense.
Military spending.
Well, now it's interest expense, right?
So we're right under, according to Debt Clock, we're right under $30 trillion. So our biggest expenses are Social Security, Medicare, Medicaid. Okay, those are signed into legislation. You have to pay those. Now, you can take some of the administration cost out of that, which is what we're seeing the Doge Commission do. They're pulling out some of the admin expense from that Social Security. When you hear the Democrats, forget about politically. I'm all for cutting idiotic expenses, like we need to. Okay, so when you hear the Democrats crying about they're cutting Social Security, they're cutting administrative expenses out of there. They're cutting the red tape and just the fat. Like you don't need 50 people sitting around one phone waiting for it to answer, So they're cutting some of that, and that can be cut back a little bit. But these are signed into legislation. You have to pay those benefits. They're promised. And the other thing that you have to pay is the interest on your debt. Because if you don't pay the interest on your debt, then you default. You're literally defaulting. Now, we all know that the soft default is inflation. We can go into that in a minute. But going back to these huge numbers. So we have $9 trillion of debt that has to be refinanced this year. So why is that important? Well, it's important because throughout the course of this year, we need Besant, who has been extraordinarily critical of Yellen about having to.
She refied everything on like overnight money, basically, is how she did it for the last year. Before
That's a very precarious situation.
She just pushed it a year into the next administration.
Why did she do that? She pushed into the next administration. She kept the paper very short because they're playing a game of chicken. We need the rates lower. The Treasury they enable Congress to spend maniacally. That's what the Treasury is. Their job is not to make the budget. Their job is to manage the budget. The legislators make the budget. So Treasury's put in a terrible position. They have put out charts. I've posted them. You've reposted them. They're like that. They say that the chart says this is an unsustainable fiscal path. They show it. They're literally begging Congress, can you get your act together? We can't keep doing this. Okay. Yellen should have known. She had been the chairman of the Fed. She knew that when we printed $5 trillion, we were going to have inflation and we're going to have to raise interest rates. She should have gotten ahead of this by issuing longer term debt. She didn't. The interest rates went up. And so what did she do? She pulled back and started issuing Treasury bills that are like almost overnight. They would expire or mature in like a week or a month or 3 months and maybe a year. But now that goat has now pushed all the way through the BOA, and here it is. What are we going to do with it? We got $9 trillion that we have to deal with now, and it's like almost 12 in a year.
And anybody that understands markets, when you have an oversupply, like a $9 trillion worth of oversupply of debt being issued into the market, what does that do to the price? Well, it makes the price collapse. It causes the yields to, blow out. And now you're dealing with people, everything on the planet is valued off of these rates, right? Your house, businesses, everything.
Car
and
loans,
so if they're all blowing
insurance,
out, what does that do to the prices of everything? Well, it causes the prices of everything to get annihilated. And so they have to offset this with. So that would be the key take. Like, you got a Bitcoiner audience, right? So what's the key takeaway of everything we're describing? When you have a lot of volatility in the market like this, whether you're talking equities, fixed income, whatever, that volatility, that fierce volatility, is just sucking liquidity out of the market because one person's positioned this way, the other person's positioned this way. And when that person blows up, all these promises compound and cascade through the market. So all this movement, all this intense volatility that wasn't expected because of tariffs is just sucking liquidity out of the system. The Fed, all the central bankers, not just in the US, central bankers around the world are going to have to print to offset this to keep more monetary units into the system by adding more into it. And so what does that mean as a Bitcoiner? I think everybody knows what that means as a Bitcoiner. If they're adding more monetary units to offset this chaos that wasn't expected, it's going to bid. So now where the timeline, I don't know, but when I'm looking at this over the next 3 years, 5 years, it's going to bid like crazy.
And that's what, and so people are thinking, well, maybe what their goal is, crash the economy quickly, right? Let's just crash the economy quickly, get it over with, and then I could say, well, we were for Main Street, not Wall Street, because Main Street doesn't care if the stock market crashes. They don't own the stock market, right? So crash it. The Fed has to come in and save the market, because if the market crashes, we are so financialized as an economy that in the United States that if you crash the stock market, you're going into recession. Okay, our tax receipts go down,
way down.
Our deficits blow out. It gets to be a major problem. But when you say, well, let's just crash it, and then maybe the rates will come down, and then we can refinance all of that debt at a lower rate and bring that $1.2 trillion interest expense down to maybe $400 or $500 billion, cut it in half. That's what they're hoping, But
it's an old playbook. It's a playbook of the petrodollar system where, and this is the key word, you had globalization that happened under the petrodollar system. For 40 years, the reason inflation kept going down is because you were exporting it out, right? you were having
the dilemma.
You had greater and greater cooperation as from a global perspective, so that you got more and more and more efficient over that period of time. That efficiency is why you never saw the inflation show up in the gauges. Okay, so now Ray Dalio just came out with an article, I think 2 days ago, and he says tariffs are a reflection or a shadow of a much deeper thing. And that deeper thing that he's saying is, instead of it being this globalization, you're having deglobalization. You're having, the world is not, I'm not buying flowers from wherever 6,000 miles away because it's more efficient through this dollar system that causes that price to be the most affordable to me living in the US. Now that's all unraveling, which means all that inflation that was pushed out is now coming home to roost in all of these different domains. Doesn't matter. It's not just US, it's everywhere. And so you're having deglobalization unfold.
And so this exact moment is what we're watching in the market as the equity markets draw down, and you have the bonds also draw down. Then you see that there is something broken in the system. There is something broken, and this is all like teetering on the edge of blowing up in this administration's face.
And it's the money. It's the currency. I won't say the word money. It's the currency, but getting people to be able to wrap their head around going far enough upstream to understand all these different ideas and go far enough upstream and saying, what's causing all this? What's causing it is the currency is breaking down, period.
That's right.
Period.
And so, I wrote about this a couple of weeks ago in my newsletter, and there's something on Wall Street called the basis trade. And I don't know if it's happening yet, but this absolutely could be the cascade that we're seeing here. Because what the basis trade is, to make it very simple for everybody listening, the basis trade is where hedge funds they'll do arbitrage. This is what my past life was in arbitrage, right? And what you do is you buy a bond, a treasury bond, at a price and getting a certain yield, and you short a treasury future at another yield, but the one that's very similar, right? And you'd short it there, and there would be like, I'm not going to get complicated, but really what happens is you buy this bond, right? And at the same time you're buying it, you repo it out, right? And so overnight repo it, meaning that you lend it to another bank or another hedge fund through the private repo market, and you get cash for that, right? So that enables you to do this trade where you can then sell this future against it. It's a lot of like concept, but to simplify it, you own a bond, you're short a bond, right? But all that buying and selling and the repo, all that, it enables you to do this trade for very little money, and you're just trying to capture basis points, like hundredths of a percent, right? And so in order to make that make sense, you have to borrow a lot against it to do it, meaning you have to lever the trade up 20 times, 50 times, 100 times. Okay, so now you get your head around this. You got these huge hedge funds doing what's called the basis trade, where they're levering these trades up for tiny little margins of profitability, so that you can make not just 0.01%, but maybe a full percent on this thing if you lever it up 100 times. Here's the issue. There's $1 trillion worth of this trade. And what's crazy about it is this trade is so big, and it could be so explosive, and we may see it unwinding here. We may be seeing the beginnings of the unwind here of this basis trade. But
Can I just stop you there? Because there's a couple of interesting things. What is the effect of that trade being so big? You mentioned $1 trillion. And when you say unwind, do you mean collapse into becoming unprofitable, and thus the holders of that trade carry losses that have to be covered somehow?
Because of exactly what's happening right now in the market with either China is selling treasuries, or traders and investors are anticipating them selling. And so they sell those bonds. And what happens is those bonds that you're owning, they go they go down in value, yet the futures aren't moving like that. They aren't going, down in value. It's, in commensurate, right? And so the spread blows out and it blows up in your face. So remember, if you're making a few basis points on this and you're levered 100 to 1, well, if it goes down, not just a few basis points, but 0.25% or something, 0.5%, like this is like it blows up the trade.
So a previously stable relationship between two securities, a bond and a futures,
breaks.
That breaks apart.
Right.
That trade becomes wildly unprofitable.
Right.
Huge losses are held. But because the trade is such a huge one on aggregate,
Right.
that's a massive risk to the system. So what happens then?
So we've seen this before. We saw it in 1998 with long-term capital management. Long-term capital management is a hedge fund that had done this trade where they were doing just the same stuff. They were doing basis trades.
But through the whole market, they were doing the whole market.
They were doing risk arbitrage. They were doing all kinds of stuff, but lots of little arbitrages that they levered up 100 to 1.
Can I just add a little context to that for people listening? LTCM was probably the first financial engineering hedge fund, and they were doing things that nobody had really heard about. When that blew up, rather than Wall Street learning the lesson from that, their talent went elsewhere because a lot of firms were like, oh, what were you guys doing there? Come over here. And so then we had Enron after that. And that was a completely different level of financial engineering as well. An energy company effectively became the world's largest, or maybe it wasn't the largest, but it was a large hedge fund. Mm-hmm. And the same thing happened when that blew up. Now, along the way, those firms went broke, but essentially the government covered the losses.
Well, what happened? Yeah, well, this is what happened in 98. In 1998, with long-term capital management, and I've told this story before, but I'm sitting on a hedge fund in Fort Worth, Texas, and we were an arbitrage hedge fund. We had convertible arbitrage, we had risk arbitrage, we had pairs trades. We weren't doing the basis trade stuff, but we had exposure to the banks who were counterparties to this. Okay, so I get a phone call from somebody, and he says, "Hey, do you guys have exposure to Goldman Sachs?" And we're like, meaning, was that one of our bankers? And it wasn't one of our prime brokers at the time. And so no, we don't have any. He was like, why? Because they're going under today, like midnight tonight, they're going under. So what was going on? Well, what happened was the head of the New York Fed held a meeting, emergency meeting with Goldman and all the big banks. And he essentially brokered a deal for the big banks to bail them out, to save those banks from the losses of long-term capital management. Okay, so that was the first real Fed put, the real one. We heard Greenspan talk about it before, but they never did it. That was the first time they actually did it. They fucking did it, and they saved Wall Street by like brokering a deal. Okay, so now flash all the way forward to today, and where are we at? Okay, we got the same issue. Nobody's learned. We have a saying, actually, Archie, for those guys who get blown up on Wall Street and you lose millions or tens of millions of dollars. Well, they call it getting struck by lightning. And nobody gets struck by lightning twice. You learn from your mistake. You're a very smart person. You're not going to take those risks again. So we're going to put you right here in this beautiful desk. We're going to give you $100 million to play with now, not just a few million. That's what they do. And so now, flash all the way forward to today, you've got this basis trade going on. Okay, so the Fed now recognizes it. They're like, oh my God, what are we going to do if this thing blows up? Okay, well, there's this little research firm, right, that is that's out in DC. It's called the Brookings Institution, right? And it's not part of the Fed, but it has a lot of ex-Fed officials in it, and it's so it does research, and it does it kind of floats ideas out there, writes white papers about
it's a lobby
things.
group, essentially.
It's a lobby, yeah, exactly. And well, it's
there's no such thing
heavily
as a think tank. They are all lobby groups.
They're called the think
Amen,
tank,
Archie.
right? That's fair. So, exactly. So call it what it is. So they just wrote a white paper a few weeks ago that said, hey, there's this basis trade that's out there. There's $1 trillion of paper out there. It's dangerous. And we think that what the Fed ought to do is get ready to take that trade off the books of the hedge funds. Okay, now wait a minute. Wait, hold on. Time out. In 2008 and 2020 or 21, we printed trillions of dollars, 1 trillion, 5 trillion. And the Fed literally went out into the market and bought paper in the open market by printing money and throwing that money, just splashing that money into the market to, give liquidity to the market. Okay. So they're like, well, we can't print money like that again for this trade. What can we do? Oh, I know. We'll just take the trade off the books. We'll take the long side and the short side. We'll be hedged. That way, the Fed will have the trade and the hedge funds won't blow up. We didn't have to print money. It's beautiful. But the reality is that's literally like, I can't think of a more appropriate definition of not QE. Where
Well, it's a lot like the backstop facility.
exactly
right?
the
Yeah.
BTFP.
Yeah.
Where a bank term funding program where they saved all these regional banks because of their exposures to Treasuries back when Silicon Valley Bank collapsed. But the point is that this is where we are at.
Nobody has to
system.
take responsibility for their bad decisions.
Oh,
And something I would like to say on this basis trade that I don't know, this is how I think about it. So in Japan, you had really low interest rates, like nothing. And
For 30 years, 40 years?
and that's important, for a really long time. And so if you think about it like this, I can go over there, I can borrow a bunch of money in yuan, okay, at nothing % interest.
in yen.
So I'm sorry, in yen.
We were
Thank you.
talking about China before. It's okay.
You borrow it in yen and it's no interest, right? And then I just take that, I convert it into dollars, and then I can go buy US Treasuries that were yielding, let's say 4%. And so you can see the natural incentive that's set up because of this interest rate differential. But in order for that to continue to work, the currencies have to be somewhat pegged to each other and they can't fluctuate too much. Because if the currencies are changing in their valuation to each other, then all of a sudden this percentage gain that you're getting by borrowing money for nothing, coming over here and buying, and you don't just have to buy US Treasuries, you could buy equities, you could buy whatever.
Trade. Yeah.
But the incentive is the part that's important. And the duration of this incentive was decades. And now all of a sudden you have such wild fluctuations in the currency of the yen to the dollar and everywhere else in the world that the whole trade is just unwinding, but there's so many people in it. And this is really important. When you're dealing with treasuries, you can lever up massively because they don't fluctuate in percent change that much.
And they're pristine. They're the pristine paper of the world. This is
right?
like you can borrow so much against treasuries. This is called the haircut, right? So the haircut is where you get margin from your prime broker or whoever, the repo, whatever it is. And the haircut is like if it's 50% haircut, then you can borrow 50% against it. If it's 95% haircut, where's the haircut? And so
But this
the
speaks to
treasuries,
how-
you get the smallest haircut because they're like everybody will loan against the treasury. It's almost perfect paper. They call it risk-free. They call it risk-free, but it's not risk-free.
It's the trade that worked for so long that everybody thought it was risk-free.
Yeah.
And now you're at this inflection point because deglobalization is happening and you're getting this massive shift that was a multi-decade long trend that everybody piled into. They thought it was risk-free. It's not. So how do we allow all these hedge funds and people that were putting it on to walk away? Nobody gets hurt. And it's what he's saying.
Back to the
Brookings,
trough.
yeah.
They need them to come back to the trough. They've got to take in these treasuries.
I want to park that discussion and come back to it in a second because I want to go back to Trump's tariffs, the debt, and what interest rates are actually doing.
Mm-hmm.
Because, they've been saying we want to encourage reindustrialization ostensibly. I don't buy it, given, the timelines we've discussed about how long it takes and what the prospects of a reindustrialization dividend with respect to jobs, wages, that just doesn't seem likely, because if something's going to take a minimum of 5 years to actually manifest in benefits, you're not going to be taking 5 years of pain for that. You're not going to be taking a collapsed economy for who knows how long. Tax receipts, increased deficit, all of those things. So the only thing that remains, I said at the start that I don't want to go into motivations, but now that we've laid out the groundwork and the framework for what's actually happening, I think it's an opportune time to do that. So the only thing that remains is essentially what we've alluded to, is bully the market into lowering rates.
Bully the Fed. Yeah.
So, and
Archie, I'm going to sound like such a Bitcoin maxi right now, okay? But I think the only solution to this is you have to start inserting Bitcoin into the issuance of the bonds in order to actually have a real free and open market for anybody wanting to buy it, right? So is that 1%, 2% of all issuance? I have no idea what the number is, but like, I don't know any other way that they can create free and natural open market demand for sovereign issuance other than that.
Okay, there's two things.
But they won't do
There's
it.
two things with
They
that.
won't
One,
do it yet, but
there's
yeah.
okay. If we're dealing with the issue of confidence in the US dollar or the US government or US treasuries, all the same thing essentially, right?
Yeah.
There's no real evidence that the people who would buy those treasuries are going to be given any sort of comfort by the presence of Bitcoin attached to those bonds. I mean, you and I, we understand the benefits, right? But there's no manifestation in the Bitcoin market.
My argument against that, and you might be right, but if I was going to counter argue it, I would say, well, look at the oversubscription on every single convertible debt offering that MicroStrategies had. And I know that's
who's buying that? They're hedge funds, right?
Well, the open market's buying
mostly,
it.
mostly hedge funds and some just institutions that can buy convertible bonds.
So I don't know too much about the demand for US treasuries. Who are the biggest buyers of US treasuries? Are they sovereigns or are they
Well, let's talk
corporate
about
institutions and private?
I mean, the one that's the trend of the biggest buyer is stablecoins.
Yeah, yeah.
Right?
Stablecoins. Yeah, they're
number 7. Tether's number 7 in the world right now of buying U.S. debt, and I don't have no idea what the number was a year or 2 years ago. So, like when you're looking at the meteoric rise of the buyer, that's the one that I'm looking at and saying, why is that happening? What's causing that?
Which is retail.
Yeah. So for me, and I don't even know that would work, the Bitcoin-backed bonds, right? I don't know that it would work. I just don't have any other solution. Like I can look here at Trump with the tariffs and everything, and I can say all the reasons why it won't work. My biggest pet peeve as an engineer is problem definition without offering a solution to the definition of the problem you just defined. Okay. So we're defining all these problems, but nobody is able to cough up a viable solution. And when I'm looking at a viable solution for like, if I'm in charge at the Treasury, I'm at the president in the US, the only thing I can think of is that you have to start backing all of your sovereign debt issuance with a sliver of Bitcoin in there to make it a viable thing.
To your point,
the market actually wants to own.
I agree. But to your point and to your question, who's the biggest buyer of U.S. Treasuries? They're pension funds. They're endowments.
Yeah.
Mostly pension funds. Well, pension funds.
U.S. pension funds, global.
Talk about suckers at the table.
Mostly U.S. pension funds.
Yeah.
And those guys have a mandate to own a certain amount of treasuries because
they're safe.
They're safe. And they look at their chart of their obligations, their future obligations, and they know that they have to have a stable return in their portfolio to help get to that obligation in the future.
In nominal terms.
But here's the problem, in nominal terms. The issue is that those benefits will adjust according to the CPI. So if we run into a period where this is where the bond traders, this is where the bond vigilantes come in, which is if we run into a period where we have super high inflation, that blows up that trade. So who wants to buy a 20-year, 30-year treasury right now 3.5%? Nobody. Why? Because there's a very high risk that we're going to have excessive inflation in the future and that those will be negatively yielding, meaning that your yield on that treasury will be lower than the inflation. Now, the reality is inflation is not the CPI number. The inflation is really more closely tied to the expansion of the money supply, which is somewhere between 6.9 to 7.1% since 1971, according to which measures you look at, but around 7%. That's not the CPI of 2% that we keep quoting. It's not even close. So, and they understand all this. So it is a problem that I do believe, and I agree with you, that Bitcoin bonds could be a great solution. And Andrew Hone is the one who came up, well, he's been the one who's been lobbying for this or floating this idea recently. And it's a great idea, but its time we're not ready yet because we're just not there yet.
That's the thing about when you mentioned about designing something with an engineer's mind
to solve it.
Yeah, it's like, okay, well, when you're an engineer, you design based on physics, validated by physics, right? But when you're designing, when you use first principles and then you have to validate it by markets, which are essentially just human behavior, very unpredictable, like you would have expected, or a lot of people expected, yields to come down with what Trump is doing, but they've gone up.
I mean, Luke Gromen sure didn't think so. He came out 2 days before the rates started going up and saying, just wait till everybody sees the rates go up. And that's exactly what happened. So there are people that are seeing the math. They're seeing the lack of cards that the U.S. has to play when we're importing all the physical things. Like you have to think from first principles.
So what's okay? Then great. If that's the goal, right? That's the end point. Bonds with Bitcoin attached or Bitcoin exposure attached to it, right? How do we get the market, or what needs to happen within the market before that can become a reality? Because at the moment, I just think the market is so far removed, so far away from being receptive to that.
I want to just say the goal or the end state is stability in the markets and bridging a dying system to a new system. That's the goal, right? And doing that in a way where the least amount of people get hurt. And so when I'm saying, what can I do to engineer that solution? I personally think that the best way you do that is you have to start backing the sovereign issuance with something. So you can do that with Bitcoin. You could do it with gold. You can do it with something that the market is going to look at that and say, well, is there some hedge built into this that protects the buying power and my savings by buying this thing in a free and open market kind of way and not being manipulated by the Fed just stepping in and buying it like QE, right? So how can you construct that so that the market actually wants to buy it? One of the things that I find so interesting about Bitcoin is you can do time-locked multi-sig on the issuance. So that if it matures in 10 years, and I'm the buyer of that, I know I'm actually going to receive what I purchased and not get rug pulled by the US or you name it country. I mean, where this is really powerful is the municipality who can't print their own local currency and offset their stupid decisions. That's where this is really important, let alone at like a federal level that controls their printing press. So they better really be paying attention if they want to be able to navigate this. But why I like Bitcoin is because the buyer of it, if they actually understand how it works, knows that at the termination and the duration of this, that because they hold one of the keys and it can be time locked, they'll actually receive the thing on the other end of it.
How do we get them to want to receive that?
Knowledge.
And that's
shows like
the point. That's the point that I'm making.
Yeah.
I just think at the moment, we're not quite at the point where the market recognizes the value enough to be able.
That's equivalent to, so this is important too. I can construct a bridge that solves my ability to get to the other side of the river. If everybody standing around me cannot wrap their head around what a bridge is, does that mean that making a bridge is not a good solution?
I don't think that analogy holds with Bitcoin attached to a bond, because with confidence, you have to perceive the benefit. With a bridge, you can actually just walk across the bridge and demonstrate it. Whereas we don't really have, the United States government doesn't have the time to wait long enough for Bitcoin to demonstrate its benefits to the level of investor who is at the moment rather skeptical.
So Archie, when you look at financial markets, everything's a projection of the future and nobody knows what the future is going to be. But what we can do is we can look back and we can say, what has been the performance of Bitcoin against the S&P 500 over the last 4 years, 5 years, anything that's like a decent time, not the last 6 months or the last 30 days, but like the last 3, 4, 5, 6, 7 years. And when I look at Bitcoin's performance to anything else, it's outperformed it, period.
It's been the number one performer in 9 out of the last 12 years.
So I don't think that's up for debate.
So when we're talking
we're
about,
all in agreement on that one.
So when we're talking about engineering a solution that involves financial projection, right? I don't know what to tell people. Like I can lay it all out. I can show how there's a network effect that's happening. We can look at hash rate. We can look at, the U.S. standing up a strategic reserve. We can see here other countries are doing the same. Like all of these things. I can't predict the future. I can't tell you what the price of Bitcoin will be. But I can look at something that is engineered very soundly, which is, the source code. And I can say, and if a person was really concerned, if you're a government and you're really concerned about it, okay, well then maybe incorporate some gold and hope that the buyer trusts you to deliver it. But there needs to be some type of backing to anybody in government, whether you're at the local municipality or you're at a federal level, you name it, country, anywhere in the world. If you think you are going to have stability in the issuance of that stuff, that you're going to have a real buyer for it, and you're not backing it with something that's going to protect the buying power, I think you just don't understand where this is all going. Period.
So when I look at Bitcoin, I think, 2021 was probably the coming of age of Bitcoin, and the ETF approvals 15 months ago was probably the debutante ball for institutional investors to come on board. And by the time we get to the point where institutional investors all have an allocation exposure to Bitcoin, maybe some years away, whereas the situation with respect to the United States government refinancing its debt is rather
imminent,
an acute urgency, right? It's almost at emergency levels. I mean, they're acting so irrationally. I wouldn't even say that.
I think it's fair.
so unpredictably, right?
Yeah, there you go.
They're taking extreme measures in order to be able to engineer circumstances in the financial markets that will enable a refinancing of their debt.
Yeah.
Which is not turning out the way they predicted.
Yeah.
So I think it's years away, maybe 2-3 years before we see that happening. Bitcoin backed bonds issued by a sovereign, right?
It comes down to the competence of the people in charge of you name it, country and treasury.
Yeah.
That's all it is. Like
and it goes back to what you said before, which is just understanding, widespread understanding. Like in my world, in institutional investing, there's still a great amount of misunderstanding in the whole cryptocurrency space. They don't see how Bitcoin is different. They don't see how, I hear it all the time. Well, somebody else could make another Bitcoin. Yeah, it's the oldest one, but who cares? They don't really understand all the properties that we won't go into because your listeners already know. But it's the understanding. And once you have that understanding and you get a big company that really understands it, a big one, you get an Apple or a Microsoft or an Amazon who says, I'm going to put this in my treasury because I get it now. Then you have that's a watershed moment. And so then you have a herd. You've seen that video that
the guy dancing on the hill.
Well, yeah, that's a good one.
I love that.
And then the other one is of the sheep that are just like they're being nudged out of this gate, and like one wanders out, the second one wandered, like a minute later, 2 or 3 wandered out, and then every sheep turns around and sees the 4 or 5 that are wandering out together, and they're like, oh my God. And then it's just an absolute herd. Well, that's the same mentality of investors. And it doesn't matter if you're retail or institutional. It's the same mentality. And they're going to finally say, this has finally moved. And we've been talking about this happening over time. It will finally move from the risk to own category and correlated with NASDAQ and general, S&P 500 and the risk to not own category, which makes it uncorrelated to anything else, even gold. And now it's something that you have to have in your portfolio and you have to have an allocation to. And once you get that, you get a couple of investors that understand that, some key companies or investors, or you get a very large pension fund, like a large one, CalPERS, Texas Teachers, that says, I'm going to put this in my endowment or my pension as a separate allocation. And this is the key to it, to the bond issuance and having Bitcoin bonds. This is the key, is that allocation comes out of their bond portfolio. And once that happens, then Bitcoin bonds all day, every day.
So, we could talk about tariffs all day, but we won't. Is Trump going to get his refinancing at a price that he wanted?
I mean, based on the moves this week, it doesn't look like it. I mean, I just couldn't imagine dropping 7 to 9 trillion and maybe even more. I mean, if they let this sell-off go like harder, like maybe they're going to have to refi like 11 because the tax receipts are so bad, 11 trillion. So
can we go into the effects of that? If they don't get the financing that they want, which is what I think that's the main reason why they're doing all of this. The second is to perhaps get better deals with trading partners as well. But let's just tackle the first one. If they don't get the financing conditions that they're aiming for and they hold off, what's going to happen to markets? What's going to happen to the economy? What's going to happen to the deficit?
Well, I think what you might find, and I'm curious if James would agree with this, is you're just not going to actually have a free and open market in fixed income.
Thank you.
That's all it's going to be, is they're going to refi it, but they're going to totally manipulate the yield through what is effectively yield curve control in order to make sure that the interest expense isn't that high, but they're the buyer.
So why haven't they done that anyway?
Because I think they're trying to think they can get this under control without going there, but I think that
the market
roads lead there.
The market's calling their bluff on this.
Yeah.
And
I don't know if this is conventional view, but I don't think they're playing 4D chess. I think they thought the market would react in a certain way.
Yeah.
And they've been wrong-footed completely.
I agree with that.
Yeah. Yeah. And I think that it's not, like I said, it's not just China. There's other dynamics that are at play here that the market is an extraordinarily complex beast. And everybody thinks that they understand it. They should have been retired a long time ago.
Yeah.
And
right.
So, and even Besant, like these, and Letnick, they're very smart people, but this is an extraordinarily complex situation. And every single time that I think about complex situations and I wonder what's going on with the market, I look at the Treasuries. That's giving you a hint. And we're seeing that the market is broken right now.
Does the name Gary Cohn ring a bell to you guys? Do you know who that is? I don't know who it is, but I saw an excerpt of an article today that said he tried to present charts, numbers, and whatnot to Trump to illustrate the point that Americans do not want the kinds of jobs that he thinks these tariffs will bring. They do not want to work in coal mines. They do not want to work in sweatshops, in manufacturing plants and whatnot, right?
I don't even know that it's that they don't. I don't even think they have the aptitude, most Americans.
Let's give them credit and say that they do.
Yeah.
They don't. They can, but they don't want that. And I see evidence of that in this country. There are certain jobs native-born people really don't want it. Most of the people who, I wouldn't say native-born, most of the people in certain jobs are either immigrants or children of immigrants, right? And then we talk about youth unemployment. So what's going on there, right? And I think a similar sort of situation is happening in America where people do have a kind of aspiration for themselves about the types of jobs that they would be willing to do. Mm-hmm. And nothing hits home harder than when you see, did you see that meme the other day of like, I think it was, look, it's an exaggeration of what an American at a sweatshop would look like, right?
I saw it, yeah.
But the projection, the intention was clear.
Yeah.
And that just looks out of place for a reason, because when was the last time we saw white, middle class or working class Americans in those conditions? 40 years ago?
Yeah.
that's not going to come back. Nobody wants that for their children, and nobody wants that for themselves in America. I know, because I grew up in a similar society. Like, I'm Australian. Maybe you guys aren't aware of that, but I'm Australian, and I've lived almost 20 years in this country. Similar kind of, I guess, wealth, and similar kind of economic structure, except we dig things out of the ground over there, right? But if you live in a city, it's virtually the same as living in London. People don't want that for themselves, and they don't want it for their kids. So who are the people that you're going to reindustrialize with these sweatshops and other kinds of manufacturing? Who are they? And who's going to take those jobs? Especially when you have, on the other end, you've got ICE deporting people because of all sorts of reasons, right? But there's a strong anti-immigrant theme to what they're doing, right? And the support that they're gathering as a result of that.
And you're not even bringing up the humanoid robots that you had mentioned.
Right.
Yeah, and that's not the future. That's like the imminent future.
By the end of this year into next year, like, you're going to have humanoid robots working in factories.
Delivered.
Yeah.
And I've seen that, and I know that there's already advanced robotics in maybe not humanoid form, but there's advanced robotics doing a lot of previously manual labor jobs right now. So I guess, I'm rambling a little bit, but if he doesn't do that, if he doesn't get his financing conditions, how long can this go on for? And isn't that just going to drive the economy further into the ground?
It can't. The economy will turn over. It'll drive it into a recession, and then it always comes back to the same thing.
I want to maybe. So I think Trump is very aware that the midterm elections, he has to keep the House and the Senate, or else he has no leverage to get anything done. So if we're looking at the market's performance, which he knows is going to be very important for that election, that has to be up. It can't be down from when he took office. So, like, when do they have to really start, adjusting markets from a liquidity standpoint in order to ensure that during that midterm election that markets are up? That
Q1's over, right? We're in Q2 now.
Yeah.
If this thing, sorry to interrupt you.
Yeah.
If this thing sorts itself out by the end of Q2, a miracle, right?
Yeah.
Let's say markets see through that.
Yeah.
And they're forward-looking, and they react based on signals that they read and receive from the insiders. You've still only got 6 months by the end of this year.
You need such a swift change in the current policies for this to be a reality that, a couple months, they've got to reverse course and they've got to turn on QE full steam. They've got to do all these things in order to make these markets run into the next election cycle. So can it happen? I don't. Well, I honestly don't know, but I would say that that's a huge consideration as they're looking at the performance of all this and where things have to go before the next midterms.
We're watching the markets crash in real time. And like we said in the beginning of the show, I mean, they're recovering a little bit today, a little bit of a bounce, but who knows where they're going to end. So none of this is resolved without some kind of agreement or laying down arms with China, with the European Union, Japan. That's right.
Mexico. There's a big trading partner.
Sure.
I don't know, right?
Yeah.
Or at least the first three.
That's right.
China has come out and said, we do not seek trouble, but we will fight until the end. Literally, right?
Yeah.
That's the foreign ministry said that. My view is that China has done its homework and has planned accordingly.
Yeah.
That's the sort of country it is. And my view of the American administrations, so not to lay it all on Trump, is that the United States is essentially a trust fund kid who's just coasting on the glory and wealth of previous generations.
I totally agree with you.
And so, he got into an Ivy League university, the American, based on, how you have that legacy thingy, right? Didn't really have to work for it. And they just think it's going to continue forever. I mean, the leadership, not Americans, but they think it's just going to continue because that's the rightful position. The British Empire had the same view, right? And it was a slow, gradual decline. Still wealthy, still one of the wealthiest in the world, but the position of dominance in global affairs. receded.
Mm-hmm.
And I just wonder.
Archie, at the core, going to the first principles of who has the upper hand in the negotiation, I just have a really hard time believing that the party that prints the paper nothings and jams them down the throat of the counterparty that's delivering the physical things has the upper hand. I just don't understand that. The one that's putting in the sweat equity to literally extract whatever out of the ground and is providing those core commodities and materials to the consumer, the net consumer. I don't think I think that they're the ones that have the power in this negotiation.
To put it even more simply, the US dollar is easier to replace than entire industries that the countries, the world is dependent upon.
Amen.
Yep.
Yes.
Yeah.
So,
and that.
but that doesn't mean that they won't get what they want in the negotiation, because there's
a codependence between the two countries, right?
Well, there's the human factor of like, okay, this is too much pain, I'm just going to give in and we're going to negotiate something, then it goes. So, but like if it goes to the wit's end and neither party breaks, like I guess that's where my argument's coming from, is the one that's actually manufacturing, extracting the real physical things, I think has the upper hand in the negotiation. But will it go there? I don't know. The human factors might mean we come to an agreement tomorrow, for all I know, right? I don't think that's going to happen, but I don't know.
So someone, and I think it's Trump, is going to want to have to save face here, because he doesn't understand how to take defeat gracefully. He doesn't know how to do anything gracefully, to be honest. But that's part of his charm for the people that support him. Yeah. So like, how do we back out of this situation? What do you think?
Gracefully?
Well, what do you think? What do you think would allow Trump wiggle room to be able to say, "See what I did"?
Yeah, right.
Right.
Well,
I did something good for my country. They backed down, not us. The Chinese, given the maturity in their statesmanship, I think would be happy to let him have something to save face for the sake of the longer term.
Sure.
But how do we get to that point?
Well, first, imminently, put a pause on it. Say, okay, here's how he does it. He says, well, 100 countries have come forward and want to negotiate. I don't have time to negotiate with 100 countries in the next 4 days. So I'm going to put a stay on these tariffs for 30, 60, 90 days while we negotiate this. And really, the big focus then is figuring out a deal with China. And you're going to use this as a front to give you time.
That's a good answer.
I
didn't have anything. That's a good answer, though.
Yeah, he's going to need to do something. And
Thank you.
Yes, sir.
A lot of people are giving credit to the people surrounding him, like Howard Lutnick and Scott Bessent as well, with their backgrounds in markets. But I think at the moment, all the messaging that's coming out is pretty much in line with what Trump wants to do. Mm-hmm. We haven't seen any kind of divergence yet. And so I'd be looking very carefully at a change in narrative that came out of the administration, any of the secretaries, even junior members, just for sort of, what do they call it, floating a balloon, when you want to put a new idea out there to see how it's received. One
thing's for sure, hang on. This
is
getting wild.
The inevitable. I think the economy is going to suffer. And I don't know whether or not it's too late to turn that around. But markets essentially are saying, this thing's going to nuke unless things turn around quickly. And that may not be possible. Mm-hmm. And if that's the case, is there an appetite? Because we know that Jay Powell is kind of almost has an antagonistic relationship with the administration. And they've come out, the Fed's come out and said, well, the bar for lowering rates is much higher than previously, which beggars belief. It doesn't seem plausible that is the case, given the precarious situation of the economy.
To your point, that they're antagonistic with this administration because Powell has said throughout this whole last administration, we are data dependent. We are data dependent. We are data dependent. We are like over and over. And I'd say, hey, look, I'm just looking at the data. The data tells me what to do. We're data dependent. And then suddenly he goes, well, we're looking forward and we're worried about the tariffs, so we're not going to lower rates. That's not data dependent. That is literally political. I mean, call it what you want, but.
And what's the situation there? Because he was asked just after Trump won, but before he took office, whether or not he would resign or whether Trump had the authority to remove him. And he basically said, no, I'll do what I want.
Yeah.
So what's the situation with the Fed chair? How does he get appointed? Because perhaps a lot of people aren't aware that the Fed is not really a government entity, is it? Mm-hmm. It's a private entity that has a relationship with the government.
Technically.
So what are the technicalities there?
Yeah. Well, I mean, Powell, he wants to finish out his term because he wants to be seen as the guy who solved this. Powell is for Powell. Trump is for Trump. It's just reality. And I wouldn't want Powell's job. I mean, quite honestly, it's awful. He's in a terrible position. He's staring down stagflation, and there's no good solution now. I mean, they made a big policy mistake printing $5 trillion. That was a huge policy error. And now they're paying for it. And he wants to resolve that. He wants to resolve it to say, I left it in better shape than it was when I came. And at this point, it's not. And so he's trying to manage that inflation. And he is hell bent on saying, I got inflation back down to 2%-ish, 2.2 or whatever it is. I got inflation back down to 2%. Despite all of this other stuff that was going on, I did it. That's all he wants. And at least if you take him by his word, which I would take him by his word that that's what he wants because that's his legacy. And he wants his legacy intact. At this point, it's not really intact because of all the errors they made during COVID.
So what's the Fed's mandate? It's unemployment and inflation, right?
Two mandates, yeah. It's price stability, which is a 2% inflation target. And it's full employment, which there's no target there. It's hard to say what full employment is, but it's kind of like, you know it when you see it, you know? So those are the two mandates. And until you have one of those break, until you have inflation come down under 2% or coming down steeply, that's clearly going to go under 2%, or you have the unemployment rate spike. And that's a measure that they use something called the SOM rule. It hasn't really tripped it yet, but once it does, then they've got cover to say, okay, we're going to lower rates because we're clearly headed for recession.
And if that happens, Preston, how will they react?
Say that again. So if the rates come down, how are they going to react?
If the economy falls into a recession.
Yeah.
The Fed, how's the Fed going to react?
Yeah. I mean, they have to have interest. They can't allow interest rates to blow out. So they're just going to turn it into a completely manipulated market that's not free and open for the rates to blow out.
Print money.
The question that I would say is going to be more of, was it 2012 that we saw Operation Twist, where they went out on the long end of the curve and were buying, basically doing QE for long duration. A lot of people think that the QE only happens on the short end of the curve because for most of the time, that's how they've always.
Is that because they want to unwind it quickly when the time comes? Or is that just the most convenient, fastest way to enact it and easiest?
It's, I think, the fastest way to put liquidity into the system. Okay, so they put the liquidity into the system. But what they also can't have happen this time is the long end of the curve is, for all intents and purposes, still a free and open market because they're not touching any of that. And what you would have is these rates, it would blow out to like crazy epic levels if they weren't kind of going there and fiddling around with the buying of the long end of the curve in order to keep them compressed. So what I think is going to be really interesting to watch if we go into a recession isn't just QE on the front end of the curve, which we've seen over and over again over the past decade and a half. It's going to be, is there somewhat of like an Operation Twist from like 2012 where they were literally buying across the whole spectrum of duration on the yield curve? And I think that they will be. But I'm curious if you would agree with that.
Another reason that they buy on the short end of the curve is because it allows them to manage the QT a little bit easier, which is quantitative tightening, which is instead of having to go out in the market and physically sell securities, which would impact the price, if they have short duration securities on their books, they can let them mature out and not replace them. And that's it's a better way for them to manage the balance sheet. It's easier. So that's another reason they do that. It gives them that ability to do that. So I think they're trapped. The issue. I believe that they're trapped. I don't believe that we're going to get to a budget surplus. I believe we're going to continue to run deficits. I believe that we are now entering a period where we are in grave danger of going into a recession that's deep enough to blow out deficits to make it just twice as bad as it currently is. And if that's the case, they're trapped. They have to do something to save it, because you can't have the treasuries blow out to 6, 7, 8, 9%. Like, that would be catastrophic for this country. So they'll have to do some sort of yield curve control, like Preston's talking about. I completely agree. I don't know what that looks like. I don't know what the acronym is going to be, but we're going to get one.
Yeah,
we're going to get an acronym.
It won't be yield curve control, though. It'll be called something else.
It'll be not QE, not QE, and it's going to be an acronym. And it's going to be brilliant. And
you've just touched on something that was really my next question. So, is why do they keep coming up with new ways to obfuscate what is essentially QE?
To not lose faith in the U.S. dollar, to not make it so fucking obvious that we're printing money and devaluing the dollar in order to manage that past debt. That's why.
Is that a tacit admission that what they're doing is in fact
absolutely
not really sound?
Yeah.
Yes.
Absolutely.
They know it. They just don't want us to know that they know it. Is that
QE.
Right?
That's why they always say this is not QE.
Their argument would be, well, if I wasn't there, the lack of stability that you have with us being here would be even worse. That's why we're justified, is because it would be way worse if we weren't in here tinkering with all these dials and keeping the relative stability that we have. Because without that, it's 10 times worse.
So one thing that doesn't really make sense to me, and I asked this to you guys as Americans, as investors, as Bitcoiners as well, is that why is the moral hazard always applied to individuals and never to financial institutions? Whenever, for example, in 2008, there was the option of bailing out homeowners, and they said, "Oh no, we can't do that because of moral hazard. People have to own their mistakes." Why doesn't the same principle apply to institutions?
I think it's easier to just kind of dupe the public, first of all. But I also think that you get a little bit of let's go back to COVID. Whenever they mailed out all these checks to everybody, we saw inflation just go crazy. And the reason that you saw that is because everybody got their check and everybody went out and immediately spent their check on the things that they never had the capacity to go and buy, because they're not net producers. They're incurring debt each month. So they got this check and they went out. And what did that do? It pulled the supply. The whole supply chain was strained because demand shot through the roof, almost like the snap of a finger, because of these checks that showed up. Mm-hmm. So when you're giving relief to all the people simultaneously like that, you get massive disruptions in supply chains and you disrupt supply demand dynamics almost instantaneously. When you do it from like an institutional standpoint, the effects there's still the exact same ill effects to the overall system, but there's a much longer lag to it than this immediate notice of it hitting the market. And so they're able to hide it and obfuscate it, like you said, by having the printing take place at the institutional, particularly the banking level. That's why they do QE. Why do you do QE? It's because you can insert liquidity. Some of it trickles down. Most of it doesn't. Most of it just gets plowed back into the hands of the people that own all the equity in the world through different cap rates. And it's hidden and it's masked way better. And it's, I guess, more politically
palatable.
Yeah.
But it's also that it's so easy to say, wow, but if we let Citigroup, we let Wells Fargo, we let Bank of America fail, Look at how many people would be hurt by that. We can't do that. We can't let it fail because so many people would be hurt by that. And that's really that's their cover.
And this doesn't mean it's right. We're just talking the incentives of why this is the path that they've taken.
So I think there's a difference between, I guess, what I was thinking about and the example you gave with COVID and the stimulus checks that were given out to people essentially to use as discretionary spending. But in 2008, where essentially the housing crisis came about because people could not pay their mortgages, there could have been some kind of relief for the people who could not pay mortgages.
Yeah.
For that specific purpose only, rather than on the back end buying out the debt securities, and saving the banks, who then used that additional balance sheet or liquidity or whatever you want to call it to then finance hedge funds and private equity to buy hundreds of thousands of homes. If you need to go,
no. I was just I agree with exactly what your point is here. Okay. But I think you also have to look culturally how much different things were in 2008 with this idea of like it's because that's a very socialist kind of response, right?
But I would say that the response was socialist just for corporates anyway.
Well, no doubt, but I don't think that if you lined up 100 people off the street, was this a form of socialism? People would be like, I didn't even really realize what happened. Would be what the typical American response would have been at that time. But if they bailed out all these people that were upside down on their homes, I think it would have been like, wow, that was really like quite a socialist response. And at that moment in time, having, been an adult in the 2008 crisis, I just think that it's so different culturally in the States, I'm assuming here in the UK and all around the world today in 2025 than it was in 2008, with that being somewhat normalized and being a quote unquote acceptable.
Yeah, there's definitely a cultural clash of values. Whenever I speak to Americans, it's not really so pronounced, but it's definitely there. Every now and then it will just bob up in certain discussions around where politics and economics collide. And I guess it depends on how you frame that question. If you frame the question about, look, a bunch of banks lent money to people they should not have, and those mortgages are bad, and the economy now is in a position where it's tanking. Should we bail out the banks who had systemic responsibility for managing risk and their balance sheets, or should we bail out American people? You see what I mean? There's just a different way of doing that. And I understand there's a really strong aversion to the word socialism in America, and particularly in libertarian circles as well. But I just look back and I think it comes back to the point about moral hazard only applying to individuals, not to financial institutions. And I think the leadership within the administration at that point of time said, it's better to prop up our financial institutions. The people within those financial institutions bear absolutely no responsibility or obligation towards their role within the American economy, only towards their bonuses and their shareholders, you see. So it's not really a two-way street there either. So I just think the principle of moral hazard is a good one. It's a sound one. You should eat your own cooking. You should bear 100%. Your own risk. Yeah. And I just wonder why there's such an aversion to applying that to the people whose business it is to manage systemic risk, right? If I go broke, that's my problem. But if 1 million people go broke on their mortgages, that's not a failure of individualism. That's a failure of policy. That's a failure of risk management. That's a failure of the administration.
Fractional reserve banking itself.
All of that comes into play, yeah. And I just think that lesson has not really been learned. And I wonder, is it a cultural difference that allows that to just go by?
Well, I think you're inherently dealing with a fractional reserve system that is built on this Ponzi scheme of creating more units in order for the system to quote unquote grow, for GDP to grow, right? And when you really deeply understand how the fiat system works, you understand that this is the underpinnings. And so that these blowups are going to continue to occur. And so then you have to ask yourself, what in human nature is going to when we look at the politicians and we look at the people that are in charge, how are they going to resolve the inherent nature of this fractional reserve fiat system? Are they going to do it through institutions and not rescue the individual because the individual doesn't even really understand that there was a gaping hole and the whole system was unraveling because of the inherent nature of it?
So my contention is the individual paid the price for their profligacy.
Oh, no doubt.
Guys, but
no doubt.
The institutions did not.
I think it's simpler than that. It's if you let a bank fail, a big enough bank fail, there's so much contagion that
It'll just keep going.
It's what you just said. There's so much leverage in the system. You
Yeah.
cannot let it fail, because if it does, the contagion is so widespread
It's so
that
massive.
that it's a cascading effect and it all goes down because we're so levered. And that is exactly why you have a think tank coming up with a paper saying, we should just take this $1 trillion right off these hedge funds' books, because we can't have the basis trade blow up because it could take down the whole street. And
Because it's
that's
levered,
where we're at.
the system's levered 10-1. Like, if they allow all that leverage and all the promises in the system to unravel, this is the fractional reserve inherent nature I'm talking about. If you allow that to continue to unravel without stepping in and plugging the hole, you'll take something that's $100 and you're turning it into $10 across the board on the value of everything. And so, like, what does that do for home prices? What does that do for stock portfolios? What does that do for anything of value? It melts down to catastrophic. It's not down 70%. It's not down 50%. It's like down 90% to get to the root of the base money or the base units that are like there, right? So, yeah, I think it's inherent of how the fiat system works that so few understand. And it doesn't make it right that they're rescuing the moral hazard. Like, I'm not making an argument for how they should do it one way or the other. I'm trying to talk through the incentives of why they keep doing it the way that they've done it is really
Sure. I guess my contention is if you carry the burden and responsibility for your own risk, systemic issues are less likely to blow up.
We're past that point.
As often. I know we are
That's the
now
problem.
way beyond that. And I think that point was passed. The precedent was set with long-term capital management.
I agree.
Yep.
And then I remember when we got to Enron, and then in 2008, I remember the Obama administration was asked how they came up with the figure of $800 billion as a bailout figure. And they just said, we wanted to pick a number large enough that nobody could imagine us doing to instill confidence in the market.
The irony.
Mm-hmm.
Now 800 billion is
Nothing.
not a big number from the Fed
Yeah.
or the government.
It's nothing.
So that's how far down
That's where we're at.
we've gone. So I'm like, okay. So QE is going to happen. When I look at the charts of liquidity, and it comes to the discussion that you had with Michael a couple of months ago now, February, I think it was early February. That was a fantastic discussion about what liquidity is, because it's all very well and good looking up on TradingView liquidity global M2. But I have to put my hand up and confess to not knowing what comprises M2 exactly. And we don't want to go through all of that right now. But in terms of where we are in the liquidity cycle and what that potentially means for markets in the context of what's happening with tariffs, rates, whatever. How do you guys see that?
Well, I mean, Michael is very smart, and cross-border capital, Michael Howell, and he puts out liquidity measures and this proprietary measure that he does, and
no one's been able to reverse engineer.
Right, and it's a fantastic. To me, I really like his work, and but he thinks that liquidity, the way he sees it, liquidity moves in like 5 to 6 year cycles. And we bottomed out this last local cycle in 2022.
Yeah, I'd say about 12 months ago, would you say?
I think it was in October 2022, I think it.
So yeah, maybe 16 months ago or something.
And so we're on the upswing, and we should peak somewhere in the fourth quarter, first quarter of 25, 26 on liquidity. And that's where we're at. Well, liquidity drives all risk assets. Bitcoin is extremely correlated to liquidity. And it lags about a 3-month lag, somewhere about, a 12 to 16 week lag, I think, or something like that. Or 10 to 14 week lag, somewhere around that. And so you can see it though, you chart it right against it. One of the things that people that they can't really appreciate about liquidity is volatility is a drain on liquidity. And the reason for that is that volatility means that you're having these drawdowns, and the drawdowns are causing margin calls. Margin calls are causing people to sell things and make margin calls, so they're not as leveraged. So they're taking liquidity out of the system. And it also is the same thing of it's causing your haircuts to go up, meaning that if you have a drawdown, a sharp drawdown like we've seen, all these hedge funds that are levered to the hilt that are using something called portfolio margining, where they put down like 5 or 6% of a position and borrow the rest of it on something like an Apple or a Microsoft, one of the big blue chip stocks. But when you have volatility, the investment bank says, their prime broker says, we need you to put down more. We're going to make that haircut now 15, 20, 25%. And this happens when it happened in 2020 where, that haircut blew up. And we didn't see it like that before. Like this was a kind of a new thing. And this is now part of the system. So now that requirement goes up. So that drains liquidity. And the second thing happens, which is a big, big, big piece of it, which is bond volatility. Now we're seeing the MOVE index rising. And that means that bond volatility is going, it's like the VIX for the bond market. And that's jumping, which means that the banks are requiring even more collateral for the loans on treasuries, which means that there's liquidity being drawn out. So what we're seeing right now is liquidity being drawn out of the system extraordinarily rapidly. And so, but in the big picture of cycles of central bank printing and liquidity, we're still in the big picture on the upswing. So meaning that later this year and during this year and later next year, we should, or into next year, we should see increased liquidity from today. And
but that's assuming there's enough being added to offset the drain that's not just happening from the volatility, but also the drain from all the tariffs, the higher interest rates potentially, like all of those things. The math on how much liquidity needs to be added for, if you collectively took all the central bankers around the world and they're adding liquidity in, it might need to be at twice the pace of what they've been doing for markets to start for risk-on assets to start to rise.
So can we just break that down a little bit? Because there's a sort of liquidity that's created and injected into the system. And is the velocity of money part of liquidity as well? So what you mentioned about in volatile times, there's a requirement to put more capital up. It's costlier to leverage, for example, and that means there's less of that type of activity. Is that sort of a dampener on the flow of funds through the system from borrowers to lenders? Does that affect liquidity at all?
When you talk velocity of money, it's typically the turnover of like how many times did the dollar pass between the three of us, right? The pace of that.
And liquidity is different how?
It's still in the system.
Liquidity would be like there's $1 going around and now there's $3 being passed around. So like when we're saying liquidity, we're talking about the sheer number of units in the system growing and getting bigger. It's like today there was 1 unit, tomorrow there's 2 units that's being passed between us, and then the next day there's 3. That's when we're talking about M2 growth rate, we're talking about that growth in the number of units. When you're talking about velocity, it would be just that $1. It might be passed at a frequency of every minute. Then it's being passed, the same dollar is being passed every 30 seconds. So the velocity went up, but it's still just that $1. So that's the kind of the difference in the terminology.
Is there some kind of interplay between the two that creates more units within the system, more dollars within the system through credit creation, for example. The more velocity,
So I would take the
easier
velocity.
credit conditions.
I would take the
Doesn't
velocity
matter?
out of
Okay.
it. Yeah.
All right. It's just
Yeah.
in my mind. I'm just trying to think about it
Yeah.
diagrammatically, and just how do the different parts interact with one another,
The most important
and what are the emergent properties of that? Okay.
the most important part today about the liquidity is the volatility. Today, that's what you're seeing.
And so that's a dampener on
On the number
liquidity.
of units.
So essentially, just as we're in the upswing of the cycle for liquidity, we have this tariff melodrama,
Yeah.
and that's essentially, putting everything on pause, if not decline.
Yeah.
So essentially, we're all beholden to whatever happens in this.
Oh yeah.
Yes.
I called it a melodrama, but it's more a psychodrama.
I
to
mean,
be
we
honest
didn't even
with you.
have to have this whole conversation. We just could have said that at the beginning and
Buy Bitcoin.
that's
Yeah.
it.
Fair enough. And so, like, I said that the ETF approvals was essentially like the debutante ball for Bitcoin. You know, it's coming of age on the institutional stage. How far along are we along that adoption curve for institutions? Because, you know, like we tend to fantasize about what's going to happen and who's going to buy it and how everyone's going to need it. But we're always about 4 to 6 years too early about it. So by the time something does eventuate, it's kind of like a non-event for us because we've already spoken about it ad nauseum, right? So like, where are we along that scale? Because as far as I know, I see, you know, I follow the news closely. Yeah, there are some pension allocations and whatever, but it's predominantly hedge funds are getting involved.
It's been slow. A lot of the hedge fund activity is again, it's they're doing a basis trade with a hedge trade with Bitcoin ETFs and futures. The ETFs are an important vehicle, but the adoption will only occur when we get widespread understanding, and we're not there yet. That's happening slowly. Like I said earlier, we need a few very large players to admit that this is something they need to have in their portfolios, and then there will be, I believe, that will be, that will set off kind of that'll set off a more rapid adoption, widespread adoption, because people will have to say, I've got to understand this now. If CalPERS is putting it in their pension fund, I got to understand this thing. If Apple is putting it in their treasury, I've got to understand this thing. So that we need some of that. We need some big players to just say, you know what, it's time. This is something I need in my portfolio. I need on my balance sheet. That's what you need. And the ETFs make it easy. But
I guess I would push back a little bit. This was the number one ETF launch in the history of ETFs, as far as the pace and the size and all of it for the first year. And even now, I mean, the numbers are astronomically high relative to every other ETF out there. And what I also think is unknown is like how many private companies out there have exposure to Bitcoin through the ETF. And how, look at some of the banks. You got BlackRock, you got Goldman Sachs, you got others that literally have meaningful position sizes
in their own funds,
of like on their balance sheet of their books. So is it why? I don't know for how early it is to be introduced and kind of where we're at. I think the adoption has been a pretty brisk pace. Is how I would.
The ETFs are, like you said, they're the best performing ETFs ever. In the last 10 years, I think there's 2,800 ETFs that were launched, and this is by far not even close. IBIT, FBTC, Bitwise. I mean, IBIT was number one. It was just not even close. So there is adoption. It was $50 billion. It's not there yet. But it will be there. And you do not want to, you don't want to fade that right now. I just think that will be a violent move, and it'll stair step up. And, you don't want to get caught flat foot, in my opinion.
What are we talking? A move to 10 trillion or 20 trillion? Do you look at
No.
Do you look at a point, there's an inflection point where it just becomes an essential part of corporate finance?
Yeah,
Absolutely.
Yeah, that's down. That's when I was talking about the allocation coming out of bonds and into Bitcoin. That's when you're talking about a $10 trillion asset. So, and we're not there yet, but I do see that in the future.
Gents, thank you very much.
Amazing questions.
It's been a pleasure.
Awesome.
Thanks for having us.
It's my honor and my pleasure to have you both in my studio, which does make it more special for me, actually, because, it's all very well having a remote interview, and I'm grateful to people who make themselves available. But when you've taken time to build something like this, it's really nice to have guests in as well. It's like, why the fuck have I spent all this money? Is this a vanity project? No, I'll have a guest a month, so that'll.
It's a great location, I will say.
It's a good location.
Yeah,
Yeah,
this is awesome.
And I'm hoping to get more people in. I do have quite a number of guests lined up, and it'll help me to get some people who are local as well. I'm really hoping to give more voice to people in our part of the world, because the Bitcoin community is predominantly American. There are loads in terms of public profiles, but there are loads of really interesting people in Europe that I guess deserve a bit of a shout out too. So and it's time for me to get to know them a little better as well. Yeah.
Well, thank you for having us. It was awesome.
It was a great
conversation
chat.
was great.
Loved it.
Yeah.
Let's go out for dinner.
Yeah.
All right. Thanks.